Uncertainty seems to be the defining trend of 2017 so far. Whether it's questions about the impact of the Trump administration or the future of 421A, real estate players are scratching their heads trying to figure out where the chips may fall and what their business will look like in the coming months. Wherever you stand, here are 4 things the real estate industry is watching out for right now. When the Federal Reserve raises interest rates, it tends to hurt those seeking financing. Funding a project becomes more expensive, and investors turn to bonds as an attractive alternative. The question this year will be whether economic growth will pick up enough steam to outweigh the impact of rising rates. In December, the Federal Reserve raised interest rates for just the second time since 2006. But a majority of the Fed's rate-setting board predicts there will be 3 more increases coming in 2017, which could put a damper on the industry. That said, mortgage credit will likely be more available due to slightly looser lending standards, which could open up a larger consumer market and make financing more available. Nobody quite knows if the Trump administration will benefit real estate in the long run. But the industry is placing its bets on a few key moves, starting with the president's promise to lower taxes.
For middle income and for most other Americans, there will be a major tax reduction.
Investors are hoping President Trump will push for softer income taxes and faster depreciation schedules for commercial properties. This would accelerate the rate at which tax deductions can be made by owners of commercial buildings. Trump also pledged to dismantle the Dodd-Frank Act, which was passed to curtail excessive risk-taking by banks in the wake of the financial crisis. Repealing the act would potentially lift limits on the amount of money banks would need to have on hand at any given time, and could allow lenders to package together risky loans and sell them as securities. Borrowing money would become much easier, thus facilitating the flow of real estate deals. Trump's other big campaign promise? To spend big on infrastructure. In October, he revealed a plan that would offer $137 billion in tax cuts to incentivize up to $1 trillion in private investment in American infrastructure. None of this is a sure bet, however. Trump really hasn't offered much insight on where he stands on major policy issues.
How are you going to make them pay for the wall?
I will. And the wall just got 10 feet taller, believe me. It's got 10
His cabinet appointments, which include 6 Goldman Sachs alums, indicate an inclination towards the interest of high finance and Wall Street, the institutions he campaigned against. In January 2016, the sun set on the tax abatement program 421A, which provides incentives to residential builders who set aside a portion of the project's units as affordable. Following its expiration, REBNY and the Building and Construction Trades Council failed to agree on a wage provision for construction labor at 421A sites. Last November, it looked like the 2 lobbies finally agreed on a prevailing wage. Governor Andrew Cuomo even called it a forward for New Yorkers. But confusion over which projects would receive the 35-year provision caused tensions to boil over less than 7 days later. The legislature has yet to sign a new deal on 421A in the early parts of 2017, but in mid-January, Cuomo announced a new name for the program.
We call it Affordable New York.
Following 421A's expiration last year, the number of new development plans filed took a bit of a hit, and that will likely continue unless the program is renewed. A new 421A could also jumpstart investment sales of development sites in the outer boroughs, which saw a slump after the program's expiration. Several large construction loans closed in 2016, though they were mostly for office and mixed-use projects. With fears of oversupply in the luxury market, condo developers struggled to secure financing. It could be an extremely tough year for developers who purchased land at ambitious prices in 2014 and 2015. Builders are burdened with carrying costs like taxes and maintenance as they scramble to secure construction financing. Since land and acquisition loans typically expire within 24 to 36 months, these sponsors could be heading for trouble. As a result, distressed sites could be picked off by opportunist investors. Firms are earmarking funds specifically to swoop in when the original sponsors of a project start running out of cash. The market has already seen some notable casualties. In 2013, Bruce Eichner paid about $65 million for a site at 1800 Park Avenue in Harlem, which he purchased with high-interest debt. As he scrambled to secure financing to build Upper Manhattan's tallest towers, the Durst organization made its move. The firm purchased about $100 million in distressed debt from Eichner's lenders and took control of the site in May for $91 million. Big projects on the hunt for loans right now? Maclow's 1 Wall Street, HFC's 76 11th Avenue, and Extel's Central Park Tower. Will construction lenders open their coffers in 2017? If not, some big developers may default, leaving the vultures to swoop in.